Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
$29.71. That was the number on the board when the closing bell rang yesterday, February 2nd, 2026. If you're holding the stock, you're looking at a daily gain of 2.06%. The volume was solid too. We saw 23.87 million shares change hands. Now that is just a hair below the 65-day moving average, but let's be honest, that is substantial enough volume. It shows that the institutions, they haven't left the building. We are looking at a stock that is clawing its way through a breakout attempt from a really serious bearish trend.
Clawing is definitely the operative word there. It implies a struggle.
It is a struggle, I won't deny that, but look at the chart. We are technically sitting in a death cross, that ugly moment where the 50-day moving average crashes right through the 200-day floor. Usually, technicians treat that as this massive sell signal. But if you look at the RSI, the Relative Strength Index, it is sitting at 40.24. We were deep in oversold territory just days ago. The rubber band is stretched, and I think the snapback setup is right there.
Well, the technical setup might be there, but you can't trade this ticker in a vacuum. I mean, context is absolutely everything here. You quote that $29 price point like it's some kind of victory. It is recovering from a recent low of $25.71, sure, but zoom out. We are still down 51% from the 52-week high of $66.44. You're celebrating a daily gain. I'm looking at a company that has been, effectively cut in half over the last year. The subject today is Supermicrocomputer Inc., SMCI. And while you see a technical breakout on a chart, I see a company fighting for its sheer survival against a massive trust deficit.
I know why you're framing it that way. The volatility has been nauseating for anyone watching, but I view this through a completely different lens. This isn't a death spiral. This is the story of a de-risked engineering powerhouse. That governance crisis, the one that dominated the headlines in late 2024 and throughout 2025, it is effectively in the rearview mirror.
Is it, though? That feels incredibly optimistic.
It is a fact. They met the NASDAQ deadline. They filed the delayed 10K and the 10Qs on February 25th, 2025. The threat of being delisted, of being kicked off the major exchange and relegated to the pink sheets is gone. That was the sword of Damocles, and it has been removed. And look at the performance. Just yesterday, for Q2 fiscal year 2026, they didn't just beat earnings, they absolutely crushed them. $12.68 billion in revenue. That is up 123% year over year. Estimates were sitting at $10.44 billion. I mean, that is not a company fighting for its life. That is the primary infrastructure builder for the AI revolution, firing on all cylinders.
You use the word de-risked because they finally filed some paperwork. I'm sorry, but filing your homework late doesn't mean you understand the material. It certainly doesn't equal fixing a broken culture. We have to be real about what happened here. You cannot gloss over the fact that their previous auditor, Ernst & Young, one of the big four accounting firms, didn't just get fired, they resigned, abruptly. And when they left, they explicitly cited concerns about, quote, integrity and ethical values.
Auditors are conservative by nature. They get spooked easily.
That isn't being conservative. That is the nuclear option in the accounting world. That stain does not wash away just because you finally managed to get a 10K filed with the new auditor. And while you are popping champagne over the top-line revenue, I am looking at the bottom line. The margins are shrinking fast. Plus, we have an active Department of Justice probe regarding accounting irregularities and potential sanctions evasion. Shipping to blocked entities. To me, this isn't an investment. It is a high beta gamble. You're betting on volatility, not value.
I think you're focusing on the shadow of the past rather than the reality of the present. Let's look at the position statement for the bull case here. The market is fundamentally mispricing this company because of that fear. We are trading at a forward PE, price to earnings ratio of 16.8 times. For a mature, slow-growth hardware company, fine, that's a normal multiple. But for a company growing revenue at triple-digit speeds, that is unheard of. It's a valuation completely disconnected from reality.
Or it's a valuation that perfectly reflects the risk. The market isn't stupid.
I disagree. They just upgraded full-year guidance to $40 billion. They have a backlog of over $13 billion specifically for NVIDIA Blackwell Ultra orders. The demand is insatiable. The operational excellence is proving itself in the numbers. The inventory buildup, which I know you're going to critique, is actually their greatest strength right now. It's preparation for the massive Blackwell ramp-up. They are stocking the shelves because they know the customers are coming.
That is a compelling narrative, but have you considered the cost of that revenue? My position is simple. Revenue is vanity, profit is sanity. You mentioned the earnings beat, but you completely ignored the gross margins. GAAP gross margins fell to 6.3% in Q2 FY 2026. A year ago, that number was 11.8%. They have literally halved their profitability to chase those sales. This suggests they are buying revenue. They are slashing prices to move boxes. Plus, that governance overhang makes it uninvestable for serious capital. A cheap stock is expensive if the books are cooked.
Let's dig into the business model, because I think that's where you're missing the forest for the trees. You're looking at those margins and thinking commodity hardware. You think they are just selling metal boxes. But you have to understand the architecture. SMCI isn't just selling standard servers. They utilize a building block architecture.
How does that actually differ from Dell or HPE? I mean, at the end of the day, everyone is selling servers with NVIDIA chips inside.
Not like this. Most competitors sell fixed configurations. It's like buying a car. You get the trim levels available. Here's the Model X, take it or leave it. Supermicro has a massive library of modular components, chassis, cooling units, power supplies, motherboards, that allows them to snap together custom servers rapidly. It's like the difference between buying a suit off the rack and having a tailor who can stitch one together for you in 24 hours using pre-cut fabric. This is their speed advantage. But the real moat, the reason they can command that backlog, is DLC, direct liquid cooling.
Liquid cooling has been around for a decade. It's niche, it's messy.
It was niche. As of 2026, it is mandatory. We are talking about physics here. Air cooling just doesn't work for the 700-watt power draws of modern AI GPUs like the Blackwell series. If you try to air cool those in a dense rack, you sound like you're standing on a runway at Heathrow, and you're spending a fortune on air conditioning. SMCI creates ready-to-deploy racks with in-house designed coolant distribution units. They have scaled capacity to 6,000 racks per month, and 50% of that is dedicated to DLC. This saves data centers 40% on energy costs. This isn't a commodity hardware sale. It's an integrated engineering solution. That's why the revenue is exploding.
I see the engineering merit. I'm not denying they build good hardware. They have always been known for that. But let's look at the competitive landscape. You can't talk about SMCI without talking about the giants in the room. You have Dell Technologies, a $75 billion market cap company. You have HPE at $28 billion. SMCI is sitting at roughly $17 billion. There is a governance flight happening. Clients are scared. Remember Elon Musk's XAI project?
I do. That was heavily publicized.
That was the biggest AI cluster deployment in history at the time. And they diverted a massive chunk of that order, a $6 billion server order, away from SMCI to Dell and HPE in late 2024. Why? It wasn't because Dell's tech was better. It was because SMCI was too risky. Dell has a larger AI backlog at $11.7 billion, and more importantly, stability. SMCI is losing its first-to-market exclusivity because serious enterprise clients, the ones who pay the bills, prioritize governance over slightly faster delivery. They are engaging in a race to the bottom on price against giants who can afford to bleed them out. That 6.3% margin, that is the scar tissue from trying to compete with Dell.
That XAI situation was a specific moment in time. That was during the height of the uncertainty, before the filings were caught up, when people genuinely thought the company might be delisted the next week. Since then, SMCI has secured a new $2 billion revolving credit facility in January 2026. The banks have looked at the books and said, okay, you're good for it. That liquidity question has been answered. They have the cash to operate.
Has it really been answered, or is that just a Band-Aid?
It has. And regarding the race to the bottom, I view the inventory buildup of $5.7 billion not as dead weight, but as strategic positioning. They are sitting on the parts. They are ready to ship when the Blackwell chips arrive. Dell and HPE are moving slower. In this cycle, speed is the currency. If you can deliver the rack 3 months faster, the customer doesn't care about the auditor's opinion from 2 years ago. They care about trading their model before their competitor does.
But cash is the oxygen of any business. And right now, SMCI is gasping. In Q4 CY 2025, they had negative free cash flow of $45.12 million? You call a $5.7 billion inventory a strength. I call it a massive liability. What happens if NVIDIA shifts allocations? What happens if there's an inventory obsolescence issue? Technology moves fast. They are holding billions in hardware in a sector that changes every 6 months. And that credit facility, they need it because they're burning cash. It's not a war chest to conquer the market. It's a life raft to keep them afloat.
I disagree fundamentally. You can't grow a business 123% year over year without massive working capital. You have to buy the parts before you can sell the server. The credit facility supports those deployments. It's standard for high growth. But let's shift gears to the leadership, because I know that's central to your thesis. Charles Liang. He founded this company in 1993. He is an engineering visionary.
Being a visionary doesn't exempt you from the rules.
No, it doesn't. But his relationship with Jensen Huang at NVIDIA is the key to SMCI's speed. They speak the same language. They are both engineers at heart. That time-to-market advantage comes from the top. And let's be fair about the governance. They have installed new guardrails. They brought in a new CFO. They have a new chief accounting officer, Kenneth Chun. The board mandated a governance overhaul. They are professionalizing the operation to keep Liang's visionary tendencies within the lines of GAAP.
I'm sorry, but I just don't buy that new guardrails fix the tone at the top. We have seen this movie before with this exact company. The 2020 SEC settlement involved a $17.5 million penalty for revenue recognition issues. Who was in charge then? Charles Liang. The allegations then were about pushing employees to maximize end-of-quarter revenue, shipping incomplete units just to book the sale, sending goods to warehouses instead of customers. The allegations now sound eerily similar. But here is the data point that screams the loudest to me. Insider trading.
Insiders sell for many reasons. Diversification, tax planning, buying a house.
Sure, that's the standard defense. But look at the data. Over the last year, insiders sold 2.1 million shares. In the last 3 months, during this supposed buy of a lifetime that you're pitching while the stock is beaten down, there were 0 open market buys. 0. Not one executive dipped into their pocket to buy a single share. Even the CFO, David Wagand, sold 67,000 shares at $44.02 back in May 2025. If the stock is such a steal at $29.71, why aren't the people running the company buying it? They are selling. That tells me everything I need to know about their internal confidence. If the chef won't eat the food, why should I?
I see why you emphasize that, but many of those sales are programmed. They are 10b5-1 plans set up months in advance to avoid exactly this kind of scrutiny. The founders still hold massive stakes. Liang effectively owns over 26 million shares. His net worth is tied to the ship. He isn't going anywhere. But let's make this practical for our listeners. Let's talk about the investment scenarios. Let's take a hypothetical $5,000 investment at this price of $29.71. That gets you about 168 shares.
All right, let's run the numbers. Show me the math.
Short term, let's say 3 to 6 months. We have a classic short squeeze setup. 17.57% of the float is sold short. That means nearly 1 in 5 shares available for trading is borrowed by someone betting it will go down. With this earnings beat and the guidance upgrade, if we break resistance, those shorts have to cover. They have to buy the stock back to close their positions, which drives the price up further. We could easily return to the mean analyst target of $46. That turns your $5,000 into $7,728. That is a 54.5% in in months.
Or look at the other side of the coin. The Department of Justice news breaks. Maybe they find evidence of sanctions evasion regarding those shipments to Russia. That is a federal crime, by the way. Or maybe margins slip further, below that 6% line, and the market realizes they are selling dollar bills for 90 cents. The stock retests the lows. It drops back to the recent bottom of $25.71. Your $5,000 is now worth $4,319. You've lost nearly 14% quickly. And if the DOJ fines are heavy, if they levy a massive penalty, it could go into the teens.
That is the risk, I grant you that. There is volatility here, but look at the midterm, 12 to 24 months. If they hit that $40 billion revenue target and non-GAAP earnings hit, say, $2.50 per share, even at a modest 20x PE, which is low for a growth stock, the stock hits $50. Now your $5,000 is worth roughly $8,400. That's a 68% gain. The growth math is undeniable if they just execute.
That is the biggest if in the hardware sector right now. If they execute without getting shut down by regulators.
And long term, 3 to 5 years. If AI infrastructure becomes a utility, a $430 billion market by 2030, and SMCI keeps just a 10% share, we're looking at a stock price of $54 on the conservative end, putting your investment at over $9,000. But if the edge AI portfolio takes off, if the 5G and telecom integration works, the blue sky scenario puts the stock over $150. That $5,000 becomes $25,200. The upside is asymmetrical. You risk a little to make a lot.
You are projecting clear skies for a company currently walking through a minefield. My long-term view? If they become a commodity box mover with 5% margins, they get valued like a utility, not a tech stock. They become a low-margin manufacturer fighting for scraps against Dell and Lenovo. The multiple compresses and your stock goes nowhere.
We're coming to Nation Tier. Give us your final thought.
My summary is caution. I acknowledge the revenue growth. The demand for AI is real. I'm not disputing that the world needs servers. But the governance discount on SMCI is also real and justified. You see high institutional ownership, Vanguard, BlackRock, and think it's a vote of confidence. It's not. That is largely passive index tracking. They have to own it because it's in the Russell 2000 or other indices. The lack of insider buying is the signal I can't ignore. My warning is simple. Don't catch a falling knife until the DOJ closes its file. The risk of fines or further restatements is an overhang that caps the upside.
And I will close with this. The market is backward-looking. It is pricing in the fear of yesterday. We are looking at a company trading at 16.8x forward earnings while growing revenue at 64%. Compare that to Dell growing at 12%. The governance issues are serious, yes, but the filings are done. The liquidity is secured. SMCI is the pure-play pick for liquid-cooled AI data centers, which is where the entire industry is going. The risk-reward ratio at 29.71 favors the bold.
Well, the next few quarters will tell the story. We need to watch those gross margins like a hawk and keep an eye on the DOJ headlines.
Agreed. That is where the battle will be won or lost.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.